First of all, I'd like to thank the Taiwan Bond Market Association for inviting me to this conference. This is my first time I attend this sort of conference. And my instinct tells me that I'm among all the experts in bond market. The best strategy is to avoid talking about bond markets, at least directly. But what I'd like to talk about is not unrelated to the bond market. In fact, it probably have a huge impact on the bond market. I'd like to talk about the actions of major central banks around the world in the last 4 years. I think as we all know, big central banks around the world are growing their balance sheet at an unprecedented rate. For example, the biggest of them all is the Federal Reserve of the US. The balance sheet in 2008 is about $900 billion. Around at the end of 2012, 4 years later, the balance sheet has grown to $3 trillion. So that's about a 300% growth. Well, during that 4 years, US GDP has grown about 7%. I think we have to think about when the balance sheet of the central bank grows 300%, try to jumpstart the economy, and the economy responds with only 7% growth. What does that mean? What is that implication? Okay, that's US Fed. Let's look at Bank of Japan. Well, before Abe coming into power, I think they have run a sort of a rather conservative policy. And yet, the balance sheet from 2008 to, central bank, Bank of Japan balance sheet from 2008 to 2012 have grown about only 33%, from 120 trillion yen to 160 trillion yen. Moderate, you know. But watch out. You know, the new governor here may be a little bit more liberal. What about ECB? ECB in 2008 balance sheet is 15 trillion euro. At the end of last year, about 3.5 trillion, so an increase of 133%. Last but not least is the Bank of England. The balance sheet had grown 400 times in that period, about 4 years. Wow, you can see how much liquidity has been put into the market and not directly absorbed perhaps, by lending or by the real GDP. The money has to go somewhere. I think the easiest place is the bond market. Asia, of course, has benefited from this surge of liquidity. Last year was a record year. Ex-Japan, increased $120 billion, unprecedented. A lot of issuers are rushing to the market. If you have any good credit, you get record low interest rate. You get record low spreads, all good news. But it is going to end. Is there a limit? Is there a limit for central bank balance sheet expansion? Or we think it should be like our universe, expanding? Is there a limit? I think this is an enormous, important question, because if central banks, major ones, are allowed to grow much faster than the GDP, and it looks like that way today. I think some of us here, or many of us would have been able to guess what's the outcome going to be. So people talk about, well, we need an exit strategy. Is there an exit strategy for central banks today? And what is that exit strategy? Well, exit strategy, is to liquidate the asset that you purchase over time. You shrink your balance sheet by central banks around the world. I think that's pretty tough. They're still buying and buying and buying to set a target of what they call liquidating all this asset over time. I think it's a big challenge. Sorry, I have to look at my note just because otherwise. So this unwinding of asset purchase and shrinking of central bank balance sheets is a huge challenge for central banks. Very tough. And it's not clear that they do have a clear strategy on this. Now, if there is no credible exit strategy, then what we got is an overt monetary financing of government deficits. As simple as that. So basically, central banks are co-opted by government to finance the government debt. Is that the role of the central banks originally? Do central banks can still maintain independence, as we all know, used to know? I doubt it. I don't have an answer, but I think more and more governments are relying on central banks to do what I like to say, to do to be supportive of output and employment is clear. If employment is very high, you ask the central bank to come to help. GDP growth is so slow, you ask the central bank to help. And also ask central bank to be more flexible in the interpretation of the inflation target. Now it's a little bit blur. It used to be quite clear, inflation targeting. I think now it's sort of moving target now, not very clear. More aggressive and perhaps more adventurous on purchasing assets. I think my point here is this, that if this thing keep going on, and it's still going on, we have to question the ability of central bank to control yield curve. Because until last 4 years, until the financial crisis in 2007, 2008, central banks basically control yield curve. Today, at best, they control short-term rates. But I think long-term yield curve, I don't think, given the central bank losing that independence of action, I think it's less likely for central bank to control long-term rates. So long-term rates is really up to the expectation of the market about inflation. I don't think the central bank has any means to really control long-term rate or the yield curve. Well, they may have some tricks to look like they have the control. Like the Fed, they have the twist, right? It's really a trick to me. But how long that will last, I have a question. Now, if the public start to lose confidence about central bank managing inflation, what's going to happen? What will happen that will 3% inflation is the new expectation, or 5% or 8%? Nobody could tell. And that, I think, something will have the impact on the bond markets now. Who will buy 5-year treasury bills at 1% yield when you know that in the next 5 years, the inflation could be higher than that. So I think it's very important today that the central banks, today, okay, of course, high liquidity, the money has to go somewhere, and the bond market seems to be, booming. But time is, in a way, we're running against time here. So the question here is that when inflation comes, and I believe that, if we do nothing, the inflation would come, or maybe they have already come in one form or the other. Can central bank keep the interest rate from rising? But the Fed has been trying very hard to keep the interest rate low. But what they can do, only the U.S. Fed fund, short term. I'd like to quote something which I think is very interesting. Well, the Fed fund now is about between 0 to 25 basis points. And in 2009 and in August, I think the Fed made a statement that conditions likely to warrant exceptionally low levels of Fed fund rate for an extended period. And then in August 2011, say at least through mid-2013. And then in Jan last year, say at least through late 2014. So the goalposts keep shifting. And 13, in September 2012, the statement say we're at least through mid-2015. And December 2012, as long as the unemployment rate remains above 6.5%, and inflation 1 or 2 years ahead, no more than 2.5%, blah, 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 blah.
So when is the next meeting?
I just wonder, what's the next statement they're going to make? Over my dead body? Anyway, I think maybe I'm I'm quite sort of pessimistic. I share a little bit with Hang Truman with your closing statement that you hope you were wrong. Because if you are right, I think we really have a big problem at hand. To me, to summarize, is that, I think the global financial crisis here has really put the central banks, into a new era. Whether they have been forced or but they are totally different animal than 5 years ago today. And the important thing is that financial stability objectives are taking precedence over monetary stability. So they will do at all costs to avoid, country default, banks default, everything is to keep it. After the Lehman, there's no big banks going under. Central banks are doing everything to maintain financial stability. But there's a price to pay, and that is the monetary stability in the long term. And I think the inflation contract has been broken, and the independence of central banks are not like before. So I'd like to end my talk say what you think the outcome would be. Thank you very much.